Certainly, earnings are great. The economy is doing well. But it's our job to be professional pessimists in some ways and think about what could go wrong. And I think right now we continue to be overweight stocks. We still are optimistic. We're calling ourselves barely bullish now. But I do think you have to consider.
Yeah, because that would be a new. I'd give that to Bob Dahl. He likes it cautiously optimistic, barely B-E-A-R-L-Y bullish would be a good one.
Mark Cohen from our group came up with that idea. So, so we think that things are going to be fine for now. We think the market will end higher than it is now. But I think as we go into next year, we start to things that we've been worried about for years might actually happen.
Inflation.
We might see some pressure on inflation.
Interest rates.
The Fed overreact or have to react to
Why will we have inflation?
The main reason is that for years, the labor force has been growing slowly as people dropped out. And now the pool of available labor, people who are unemployed or who are out of the labor force that might plausibly get back in, is shrinking pretty rapidly, which is a good thing, right? It's a great thing. It means Americans are working. But that pool is shrinking at almost 1.5 million people per year. And if you look at the closest examples, 1960s, when you started to see unemployment go down rapidly and it gets below about 3% or so, then you really have seen a jump in inflation, not just a small increase.
Because it's pushed by wages.
That's correct. Okay. So it seems crazy to talk about that because we've been talking, it hasn't happened for years, but in 2019 we might see first example.
Colin, I was referencing mostly a lot of the things that you were saying as well. Do you agree with a lot of that in terms of just a more muted approach to the market in terms of the bullishness?
Right. Really, yes, Joe. We've run it both sort of quantitatively. If we sort of regress where you would expect returns to be going forward, you get the really low single-digit numbers from here, but also some of the fundamental points you made. You know, U.S. corporate debt, excluding the big ones like Apple with lots of cash, U.S. corporate debt has been rising. So if interest rates go up, that's going to be an extra cost. And similar to Ed, it's hard to see that labor costs can't begin to rise from here because of that labor shortage that he was referring to. So combination gives you pretty muted returns from here, but they're still positive.
It's hard to understand what we really want because we on every Employment Friday, we hear, yeah, good, but still wages aren't rising. And then I saw an entire piece on how hard it is to get truck drivers at this point, and how great the demand is, and how these guys are able to ask for a lot more money, which I thought, wow, that's great. That everybody's going to get it's a huge industry because we move 80% of our stuff with trucks. And I was thinking, what a great. If you pick that as a career, make $100,000 a year or something, I mean, it's just it would be a positive, it seems to me, for all the people in the middle class there. And is it always a bad thing that wages are going up, or shouldn't we embrace it?
It's the rate. You don't want to go up too fast, and you don't want to go up too far.
They're really not going up too fast, right?
But I think
they're just starting to catch up with what we wanted for so long, no?
Yes, and because the consumer's huge in the U.S. economy, so you want the consumer to be feeling good, and that's usually a product of their savings and wages. But also, Joe, in some of those numbers you quoted, the averages don't look like they're escalating, but we're seeing pockets like truck drivers, you said, certain areas of technology, medical, where you're really getting pretty strong wage growth now. So it's true on average, but to me that reflects a skill imbalance in what the economy recovers. If you have the right skills, then actually you're beginning to do quite well. If you don't, you're still struggling a little bit.